Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So are you or any of your clients looking to buy a house in Dallas, Texas, but they've got a lot of fear around these higher interest rates? Well, in this video, stick around. I want to teach you guys a trick and an old school tactic that's been used for a long period of time to help acquire lower interest rates on properties right now, called Subject To. Let's get into it. So listen, with the housing market still trying to find its footing, people are trying to figure out, is this the right time to buy, right? Where are interest rates gonna go? How do interest rates affect my affordability right now? Should I look into a temporary buy down? Should I wait? Should I look into potentially having an assumable loan done whenever I buy somebody's house? So there are a lot of different strategies and a lot of different tactics that people are looking into right now, and sometimes not even aware of. And there is a very, very popular one that I'm familiar with that I wanna share with you today called Subject To. Nickname is SubTo. I want to talk a little bit right now about what happens with the Subject To, why people would want to utilize it, and how it works. So most of the time, a Subject To or a SubTo transaction consists of a buyer basically buying a property from the seller, but them taking over their existing mortgage as well. Now, I want to draw a distinct solution between an assumable loan and a Subject To transaction, okay? So most people think about, hey, when I buy a house and I want to take over someone's loan, I have to assume that loan, or I want to assume that loan, because most of the time the interest rates on those existing properties are much cheaper than the current market. And so one of the things that people want to do whenever they buy a house, if that house is a good deal, but also that house has an existing mortgage of it of 3%, 4%, 5%, the current buyer buying it from the seller says, hey man, I really want that mortgage. It'll make it cheaper on me, make it cheaper on me as an investor, possibly cash flow, or just less overhead for me as a primary homestead buyer. So I'd like to inherit or take over that existing mortgage. So there are two real ways to actually do this. So the first one is the one that most people are familiar with. It's an assumable loan. So what happens is they buy a house and they take over a mortgage, but they assume it through the servicer, through the bank that they currently have the mortgage with. It's not always a guarantee, it's not always a home run, and there are restrictions on it. An assumable mortgage through a servicer really consists of assuming the existing person's loan, but the loan has to be an FHA loan, the loan has to be a VA loan, and you still have to meet the requirements through the lender to make sure that you, the buyer, even if they allow you or give you the opportunity to get approved to assume the loan, that you can actually assume the loan and you can qualify. That's part one. Part two, the challenge becomes, hey, what if somebody has a really good loan in their property, but they've got some equity in it? Let's say they've got a house that's worth $400,000. They owe $350,000 with a 299 or a 399 rate. That would be a situation where somebody would say, hey, I'll buy your house, but I also want to assume your current loan because the rate and the payment's so much cheaper than the current market. That would benefit me as the buyer and give me additional incentive to buy the property. So if that happens, and if the buyer is able to buy the property and assume the loan, the challenge becomes, hey, basically this person's buying the house for $400, they've got a loan balance for $350, they're assuming that mortgage, right, because they want the low rate in the payment. But what happens with the $50,000 that is the difference of the loan balance and the difference of what they're paying for the property? That $50,000 still has to be accounted for. So most of the time the buyer has to come up with that additional $50,000 to pay the seller, because the seller's not going to sell their property and let somebody assume the mortgage and just walk away and say, hey, don't worry about the $50,000 in equity, you're all good. They want that accounted for sometimes. And sometimes it can be done in different ways. So it can be done as a lump sum from the buyer. It says, hey, here's $50,000, we're all square, I'm taking over the loan, we're assuming it and everything's all good. Sometimes they can do it in chunks, saying, hey, listen, we can't afford to pay you all the $50, we will do $20,000 and then we'll do installment payments after the fact, and they set up specific terms. So there are a bunch of different ways that people go about trying to get us, trying to get to assume a loan, but they're not as easy as most people think, and this is where people transition into Subject To. And I want to draw a big distinction here of where Subject To has a lot less restrictions. It gives people a lot more freedom. Now there are a couple additional things that people have to do when they're doing Subject To and be aware of, but I want to talk about those now because they're really, really popular as far as assumable loans versus a Subject To. So again, an assumable loan is where somebody buys a house and the current loan that's on the property, they legally assume it. They say, hey, it's mine, right? And there are restrictions on that. primary home, FHA loans, VA loans, only certain loan types are allowed to be assumed. And so if you don't meet those requirements, you're stuck on the assumption. But a subject to is a completely different deal. What happens on a subject to, a sub-to, is that a buyer buys a house from a seller and they just start taking over the mortgage payments completely. They don't assume the loan through the servicer, they just take over the mortgage payments. Now, why is this different from an assumable? Well, if you're gonna legally assume a loan from an existing homeowner to become the new homeowner and assume that loan, again, you have to get the servicer to approve it. Only certain type of loans can be assumable, and then obviously you have to deal with what's left over on the equity to figure out, how much money needs to be given to the owner or how much money needs to be financed in order to meet that equity position. On a subject to transaction, the current lender doesn't have to approve the subject to transaction and the contract. So literally somebody buys a house, it's under contract, they do it subject to. So subject to means, hey, we are going to buy your house subject to taking over the mortgage payments. Now they don't legally assume them through the servicer, but they just legally take over the mortgage payments. Now, here's the catch on that, right? You can subject to pretty much anything in life, and you can subject to a mortgage, which is, hey, I'm gonna buy your house, it legally becomes mine. We move the deed over, we have terms on the contract, and one of the terms on the contract is, hey, I'm buying your house subject to all these conditions, and one of these conditions is I'm just gonna take over the payments. And that way there's no restriction on any type of loan. It can be a jumbo loan, investment property, conventional loan, all these things, right? Now, again, there's a stipulation with each one of these, but it doesn't restrict the person to going through the servicer. It doesn't restrict the buyer of assuming a specific type of loan. They can just do everything on any type of loan regardless, and they just buy the property subject to, there is a contract and they're subject to specific conditions, and they say, hey, I'm gonna buy your house, I'll give you some equity, here's a check for $10,000, $20,000, it's legally mine, everything's done, they record it, it's a legal transaction, everything is done, and the deed, which is the ownership, goes from existing owner to new owner, and literally that person buys the house subject to, so now they're the legal owner of the property, they have full rights of the property. It's just that the mortgage is still in the previous owner's name, and they're taking over the payments and paying the mortgage payments directly moving forward. There's not a refinance, there's no assumable, it still stays in the previous seller's name, but they're taking over the payments. Now, there are all kinds of clauses that says, like, what if you're late? What if the bank calls the note due? When banks have what's called a due on sale clause, it gives them the right, not the obligation, but the right to call the note due if they find that the deed, aka the ownership, transferred from one person to the other without paying back the mortgage in full. That's usually the biggest thing that people are concerned about, but there are all kinds of strategies, conversations, and ways to avoid this, or even if it does happen, a lot of times you can just call the bank and chat with them and they won't call the note due. So subject to is an extremely popular transaction. A lot of people are not aware of it. It's very similar to an assumable mortgage, but there are not as many restrictions. There are a lot more options. It opens people's up, and in a market where right now low interest rates are a sexy asset class, home buyers are trying to get their hands on more and more of them, and if they have any issues or restrictions with assumable loans, they can default back to a subject to, and a subject to is becoming a lot more popular. And I think that's something that you'll see moving into 2024 is people trying to navigate through this market, but if the opportunity is out there, trying to utilize a subject to versus an assumable loan. So listen, I know this was a lot of information around subject to, but if you found this video valuable, do me a favor, like, share, comment, or even give me a call to discuss specifics on subject to. We're here for you no matter what, whether it's pre-approval, mortgage conversations, creative financing, subject to, whatever the question is, our team wants to be a resource for you. So don't hesitate to call us, email us, text us. We're always here for you. Until next time, stay tuned.